The ratings agency Fitch has downgraded US debt from AAA to AA+, citing long-term erosion of governance as one of its main reasons. But how have markets reacted? Hello and welcome back to our channel. My name is Daniela Hathorn, and in today's video we are going to be looking at that downgrade in the rating of US debt and how markets have been moving since. But before we get into it, please like this video, comment, subscribe and turn on your notifications. So as I was saying, that downgrade from Fitch coming earlier this week, downgraded from AAA to AA+, citing mostly a long-term erosion of governance over the last 20 years. There's been a polarization within the government parties. Of course, the suspension of the debt ceiling until 2025 has added fuel to that. We also have rising deficits and rising debt across the country. Rising interest rates would have putting an increasing interest rate burden on the country, and of course a forecasted recession which they believe will put further weight on the country's ability to repay its debt. To all of that, of course, weighing on the market, we've seen a big rise in US yield. The most natural reaction to that is markets will sell treasuries because of this downgrade, and that will cause a rapid increase in yield, which is creating a little bit of a choppy environment. Now, a little bit of history. The last time we saw a downgrade to US debt was back in 2011. Prior to that, US debt had kept a perfect credit score of AAA. Back in 2011, it was Standard & Poor's that decided to downgrade their debt to AA+, again citing bipolarization of the government back then and an increase in instability. Since then, we hadn't seen another decrease in ratings up until now, which Fitch has taken action. Now, back in 2011, we did see US stocks fall rapidly based on this. During the month of August, which is when it took place, we saw stocks erode about 19% of their value. In terms of yields, we actually saw a drop in US yields, but this was mostly on the back of the US government actually buying bonds in the market to keep the yields low. That was the Federal Reserve buying bonds. In terms of the reaction we've seen so far, we have seen a drop in stocks. That is already somewhat expected. We have seen a very, very strong performance of stocks throughout the first 7 months of the year. We started to see a little bit of a sell-off action at the beginning of this month. We then continued to see further upward momentum as we saw a lot of risk-on sentiment on the back of that drop in US CPI and PPI data. Now it looks like we're at a little bit of a crossroad, assessing the impact of the ratings downgrade, but also the future path of monetary policy and how that may affect the stock market. But for now, we have seen that sell-off in stocks. In terms of yields, as I was saying earlier, we've seen a rapid rise in yields. The US 10-year yields now actually maintaining above 4%. Now, this hasn't started this week. We already saw that at the end of last week, and that came on the back of the Bank of Japan actually widening the tolerance for the yields on its bonds, allowing them to rise more than they have in the past. That sent a little bit of a shockwave through the market. We saw Japanese yields spiking up and also US yields picking up on the back of that. Now, looking at the current situation, we have seen this rating downgrade actually curb some of that risk-on sentiment. We're seeing the US dollar picking up some further momentum that had already started about 2 weeks ago, but we're seeing a little bit more action heading into it. Of course, we saw strong private payroll data on Wednesday that added more fuel to the fire, that the jobs market still continues to remain very resilient and therefore is giving the Fed enough ammunition to continue hiking. That, of course, weighing on stocks and the likes of gold and silver, propping up US yields and also the US dollar. Now, another thing to watch out for is the earnings season, because we do have Apple expected to report earnings later on today. They are expected to actually show a drop in their earnings because of slower iPhone sales. That, of course, can add and weigh further on market sentiment. But also looking ahead as to how US yields can continue to perform, which are one of the main reasons the US dollar remains supported at the moment. And also we're seeing weighing on risk appetite is the fact that a soft landing, which essentially means that inflation will actually come down whilst growth remains untouched, does seem like a very likely scenario right now. And if you think about it, we expect to see inflation continue to trend above its long-term average as the economy cools. That is going to continue to put upward pressure on US yields. So of course that means that the US dollar could remain supported for longer if we continue to see this trend. So in general, the reaction right now is that US yields have shot up, risk appetite has come down, yields are expected to remain elevated. We also have the Treasury Department continuing to sell debt. So for now, it looks like we could see some further weakness in the stock market whilst the dollar enjoys much needed rebound. Looking at the chart, let's kick it off with US Treasuries. This is the 10-year yield, and as you can see now, trading above that 4% area. We did actually come above it on Thursday and Friday last week, but that looked like a key area of resistance. It didn't look like we were going to manage to consolidate momentum above it. That, of course, didn't happen. We did see some strong moves to the upside here, currently trading at around 4.14%. This is the highest level since November last year. But also, if you're considering this 4% as a key area of support resistance, it looks like the break that we saw at the beginning of July was just the beginning of it. We then pulled back to gather a little bit more strength and actually came back with vengeance. So it looks like this momentum could continue, and US yields are actually expected to see a little bit more of a bullish move. Now, looking at the currency pairs, of course, the US dollar finding a lot of support on the back of that. Remember here at the beginning of July, that sell-off, that was on the back of that weaker June inflation data. We actually found some support just here at the middle of the month, just around that 99 mark, actually finding enough buying support to build those higher highs and higher lows and actually continue all the way back now towards that 102 level. It looks like we may have a little bit of resistance up ahead. In fact, where we saw that reversal start, just around that 103 area, continues to be a key area of pressure, especially now that we have the 200-day simple moving average hovering just above that 103 area. But for now, as US yields continue to remain elevated, we could expect to see the US dollar continue to push higher. Of course, that is weighing on the likes of the pound against the dollar and euro against the dollar, two big components of the US dollar index. And let's take a look now at the stock market. This is the US 100, so the NASDAQ, the tech heavy index. This is the one that has been rallying throughout most of 2023, seeing some very strong momentum. Of course, the push in AI generated hype, really seeing these stocks pushing higher, trading at pretty much 18-month highs here, as you can see, back at the levels from January 2022. Looking at the most recent move, we have seen some clear resistance just around that 15,800, 15,900 area. We've got essentially a little bit of a double top pattern here. It's going to be interesting to see whether we can manage to push below this area, below the belly of that double top. If that is the case, they could be signaling some further bearish momentum. Looking at the RSI here, we're now just up on that midline there, just around 50. That's signaling a little bit of indecision and lack of direction there in the short term. This could be when sellers swoop in to actually bring that move even lower. If that were the case, expect to see a little bit of support potentially around that 50-day simple moving average, just around that 15,000 level, before looking to pull back even further towards that 61.8 Fibonacci there at 14,249. As I said, we've got some key tech earnings coming up, Apple being one of them. Expected to see some weakness in Apple's shares because of a expected drop in iPhone sales. That is it for today's review on the downgrade of US debt. Thank you so much for watching, and don't forget to subscribe to our channel.